I think that the world is entering such a dangerous period that people should ensure that they have a lot of food supplies on hand. And the way to survive is to make sure that some of your assets are in gold, physical gold, not ETFs. Gold comes back into the BRICS monetary system. I am pretty sure that currency will be on the agenda. I think the path will be laid out as to where they are going, which will be based on 40% of the asset behind the new currency, based on 40% gold, 60% on member countries' currencies, but those in turn will be linked into gold. What may well come out of the BRICS summit meeting is not a new currency, but a path towards the new currency, because anything that BRICS puts forward has to have a unanimous agreement between all the member countries. And there are probably some difficulties with some member countries that need to be ironed out. So my guess is that what emerges is the path to that new currency, but not the announcement that this is our new currency. If you look at how much trade China is conducting in its own currency, it's now, I think, over 50%, if not higher. Virtually all of their trade with Russia is in their own currencies. But if one country like Russia has a surplus over China, which it does at the moment, the balance is held in gold in the PBOC. That's another way that gold comes back into the system. And that will probably also be part of the BRICS new currency, which will be called the unit. We know that small parcels of oil and gas sold out of Saudi and the rest of the Middle East, UAE, are being conducted with gold. But I don't think that those two countries are yet ready to launch the complete Petro-Yuan currency. It's coming. SWIFT is part of the US control system. So once BRICS gets its act together, that system is going to come under severe pressure. And China, yes, it's a big stimulus. It's got markets on fire. What is going to be the impact on China's economy? Very little this year. And my friends say it will probably add 0.5% to growth next year. My own take is that primary purpose of this stimulus program is taking preemptive measures because China's leadership understands that war somewhere is going to break out. Therefore, war would have a huge impact on China's economy. Thus, the leadership is putting in place measures to support that eventuality. China's diplomacy is passive. It doesn't want to lead war. But if Iran is attacked, they will support Iran. If there is not a de facto NATO war against Russia, but a real war against Russia, China will support Russia. I think the difficulties that China would face on invading Taiwan are immense, not least the sea terrain around Taiwan, which makes it extremely difficult for any invasion. If China was going to do anything, it would be a blockade. Stop stuff going into Taiwan. Soon Taiwan would be on its knees. But Taiwan is on the back burner. First of all, China will know pretty precisely what's going on in the world. And therefore, my take is they are pretty aware that a war is round the corner, and therefore they are preparing their economy for that eventuality. What do they want to do? Basically, they just want to stabilize the economy at these levels rather than to stimulate it. You can see from all the data that since mid-year, business has fallen very sharply, which from my friends on the ground, I can confirm. So what is being done is stabilization, not stimulating. Why did the Fed cut rates by 50 basis points? What do they see coming down the credit pike that we are not aware of? And I think that they know that there are some nasties coming down that would disrupt everything. So the other point, of course, is that you can see that employment is starting to fall sharply. The numbers that the BLS produce are almost dreamlike numbers as they emanate largely from their birth-death model, which is a guess on to what companies are doing. Whereas corporate CEOs know the name of the game very clearly, and they are letting staff go. Cutting costs is their primary objective. All retail sales are quoted in nominal terms, but if you deflate them even by the CPI, which understates real inflation, retail sales are negative. Then if you look at GDP and GDI are supposed to produce the same result. But since the first quarter of 2023 to the second quarter of 2024, GDP rose by 2.7%, GDI by 0.7, which is the best way of showing you what the economy is doing. When you look at what's happening to employment, what's happening to real retail sales and private investment, the GDI number is the more accurate one. But of course, it's never quoted. I think the American economy, if it's not in recession, is on the verge of recession and will be in recession by the end of this year. Where's that going to leave financial markets? I think with some volatility, you're going to see markets continue to grow sharply into the early months of next year. Then they will meet the headwinds of the results of the American elections. Of course, all bets are off if war develops by the end of this year, either in the Middle East or in Europe. So really, it's an extremely volatile groundwork for equity and base metal markets. I think Fed's stimulus and rate cuts is, like China, a preemptive move. I think the bond market is going to follow the profile of inflation. So short term, US CPI and global inflation is falling, but it's short term. And by the middle of next year, CPI and global inflation will be starting to rise. And that's when the bond market will turn around. So we can well see US 10-year treasuries yielding 3% by the early next year, and then that'll be the bottom. And as inflation, as we see a repeat of what we experienced in the late 1970s and early 1980s, we will see US CPI in double-digit figures, and we see US 10-year treasuries yielding in double-digit figures also. And what will that do to highly indebted global system? It's the cycle. All comes back to the cycle. It comes back to the inflation cycle. Prices of everything will rise. It comes back to your toilet paper.